Welcome back to class. Now we are starting from the Statute of Limitation and Powers of the Tax Authorities to Audit Open Years. Statute of Limitation and Powers of the Tax Authorities to Audit Open Years. Okay. The applicability of limitation is undoubtedly a good principle in the tax laws. Okay, so for audit, you can't audit more than 6 years. Okay, you can't audit more than 6 years at a time. So except where a case is being referred to the investigation team of the FIRS. Okay, so yes, this practice is good. However, as a major stakeholder and key driver for the economy, the tax authorities should ensure transparency and fairness in its application of the tax laws. So there should be certainty. Okay, there should be equity, fairness, and justice. Okay, so taxpayer should know the time frame within which it can be held responsible for previous non-compliance. Okay, so it is yes, this is probably one of the reasons for the of the national tax policy. The canvasses that there should be a periodic and timely audit by tax authorities of returns filed by taxpayers. Okay, so this perspective is inconsistent with the provisions of the Companies Income Tax Act, Personal Income Tax Act, and the Petroleum Profit Tax Act, which prescribe that taxpayers have an opportunity to recover any overpayment of tax within a 6-year period. So thus the tax laws impose a 6-year limitation from the relevancy of assessment on the time frame within which the tax authority may raise additional assessment in connection with the returns filed by the taxpayer. Okay, so the Federal Inland Revenue Service Establishment Act further stipulates that no officer shall make a demand for an under-assessment or erroneous repayment of tax after 5 years. Okay, after 5 years. Again, the Federal Inland Revenue Service Act further stipulates that no officer shall make a demand for an under-assessment or erroneous repayment of tax after 5 years. Okay, so it is logical that where the tax authorities have not carried out an audit on a taxpayer for a period of more than 6 years or 5 years in the case of under-assessment or erroneous repayment of tax, the period beyond 6 or 5 years as applicable becomes statute barred. Become a statute barred. Okay, so this should bring some form of comfort to the taxpayer. However, the tax authorities are usually not open to precluding any assessment here. For tax authorities to open the barred period is a recovery of tax on the basis that the taxpayer has probably been fraudulent in the tax returns filed or has willfully defaulted or neglected to file proper returns with the tax authorities, or otherwise has actively facilitated the circumstances from which he now seeks to benefit. Okay, I said earlier that except in an instance where a case is being referred to an investigation team of the FIRS, so this triggers tax investigation. You know, when there is a case of fraudulent activity. Okay, when there is a case of fraud, default, neglect, you understand? So it triggers tax investigation on the basis of an alleged tax evasion rather than a routine or normal audit, which should not be more than which period should not be more than 6 or 5 as the case may be. So tax evasion is a criminal offense and therefore not statute barred. Okay, so irrespective of the number of years involved. So therefore, where at any time and as often as necessary the tax authorities are of the opinion that fraud willful default, neglect, or misinformation has been committed by the taxpayer, it may commission an investigation to recover any lost tax. So depending on the direction of interpretation, a review of the provisions around a taxpayer's right to reclaim excess taxes either shows a strict 6-year window according to Citn, or a refund after a proper audit by the tax authority and eligibility rules and conditions. Though in practice the refund process is not that easy. Okay, yes, subject to the approval of the Tax Authorities Management Board according to the Federal Revenue Service Establishment Act. So when the provisions of any of the tax laws are inconsistent with the provisions of the FIRSEA, the FIRSEA prevails. But then is there a risk that the taxpayer who fails to institute a tax recovery process within the 6-year window would be exposed to a forfeiture of excess taxes paid to the tax authorities? So what happens if the overpayment was due to an ambiguity in the law, which is subsequently clarified in favor of the taxpayer by a competent court of law, okay, or by judiciary, okay? So the current state of play may warrant the tax authorities to carry out an immediate review of all taxpayers' records with a view to identifying tax authorities to carry out an with the view to identifying open years of audit, that is a period in 2, 3, 4, 5, and 6 years. So in this case, open years of audit where they are open. In this case, open years of audits where they are open is commissioned, okay, and then the tax authorities should be flexible when reviewing years that are statute bar in the case whereby a taxpayer file is being referred to the investigation team, okay. So now whatever the case, now you understand that the limitation period is 6 years. Okay, so the limitation period provisions of the tax law do not apply to collection by tax authorities of pending or outstanding valid assessment notices against taxpayer. Okay, so this should however not be a basis for the tax authorities to neglect to pursue timely recovery of valid but unpaid assessments. So this will ensure that the taxpayer does not become frustrated by the challenge of states and forgotten stale and then forgotten assessments. Are you together? So let's look at the components of the tax returns. I've always been mentioning this, that we are practicing self-assessment system in Nigeria, which became effective since January 1st, 1998. So the timing for filing is specified below. We have for a subsisting company, that is a company that has been in operation for more than 18 months, okay, for more than 18 months, okay. So the filing period is not later than 6 months. The filing period is not later than 6 months after the accounting year end. 6 months after the accounting year end. And then for a newly incorporated company, that is a business that has just commenced, for a newly incorporated company, okay, so it is within 18 months. It is within 18 months. Two things: within 18 months from the date of incorporation, from the date of incorporation, or not later than 6 months, not later than 6 months after the end, not later than 6 months after the end of its accounting period, whichever comes first. Okay, so the components of the tax returns include the audited financial statements together with relevant schedules, that is notes to the accounts, detailed profit and loss accounts, which is also part of the audited financial statements. Okay, then tax computations for the relevant years of assessment. The tax computation will include income tax computation, capital allowances computations, and the duly completed and signed self-assessment income tax form, and evidence of direct payments of the whole or parts of the taxes due. With the advent of the tax premise, okay, or with the adoption of the tax premise by the tax authority, that is the FIRS, the physical accounts, that is the physical and the financial statement, may no longer be required, though depending on the tax station and depending on the type of taxpayer. And then don't forget that the taxpayer, the tax authority, that is the FIRS, has created a department, tax premise, okay, department to assist taxpayers in their filing of returns. Okay, so they take taxpayer complaints, okay, that is taxpayers who are having issues filing their returns online, making payments online, or generating their payment reference online. Okay, so with this tax premise now, what you'll be taking to the tax authority is the evidence of filing on the tax premise, along with the evidence of payments where probably you have taxes to pay, and then the duly completed and signed self-assessment income tax form. Okay, so don't forget that in the filing of the annual returns on the tax premise, you'll be making use of your audited accounts and your tax computation, though the tax premise will automatically compute taxes by itself, okay, which you can then compare with your manual computation, okay, or which you can compare with your own self computation. Are we together? Okay, so that's that. Let's move to the next topic, subtopic. Here we have tax returns to be filed by a company other than a Nigerian company to the tax office. Okay, so I've mentioned it in previous class, classes, that the non-resident company, okay, so that is not a non-resident company, okay, non-resident company are now to file tax returns, with audited accounts, to the FIRS, okay. So this is in line with the section 16 of the Finance Act of 2020, section 16 of the Finance Act of 2020, amending the section 55 amending the section 55 of the Companies Income Tax Act. Okay, so this section now mandates the non-resident companies deriving profit from Nigeria to file their actual accounts, effectively doing away with the deemed profit basis of assessment that the FIRS utilized whenever the non-resident companies failed or were unwilling, for whatever reason, to submit actual data of their Nigerian operations. So by the new section 55 subsection 1A of STATUTE, such non-resident companies are required to submit with their tax returns, the company's full audited financial statements. Okay, the company's full full audited financial statements, and the financial statements of the Nigerian operations, so meaning they will be submitting their group financial statements. Okay, so attested to by an independent qualified or certified accountant in Nigeria, So B, the tax computation schedules based on the profit attributable to its Nigerian operations, and then C, a true and correct statement in writing containing the amount of profit from each and every source in Nigeria, and then 4, that is D, duly completed company's income tax self-assessment forms. Okay, so however, where the non-resident company only earns income on which withholding tax is the final tax, the obligation to file a tax return in the manner prescribed shall not apply to such company in that year of assessment. So this is consistent with the section. It is consistent with the section 7 of the Finance Act of 2020. So it appears that limiting the carve-outs in this way, it's meant to send a serious message that that henceforth the FRS will no longer take any excuse for non-compliance by the non-resident company. Are we together? Okay, so we are moving. So now we have section 55, subsection 7. Section 55, subsection 7. Okay, so which is talking about the powers of the service to specify the form of accounts to be included in a tax return by small and medium-sized company, section 55 subsection 7 of the Companies Income Tax Act. Okay. The FIRS may require that small companies or medium-sized companies file their returns. Okay, file their returns in such form as may be prescribed by the tax authority. Okay. So again, sorry. So section 55 subsection 7 of the Companies Income Tax Act as amended. Okay, sorry. Sorry. Yes. So though the FIRS are allowed to call to ask small companies, the Finance Act of 2019 has exempted, and then also Finance Act of 2020 has exempted small companies from paying tax. Okay, has exempted small companies from paying tax. Okay, and small companies are companies with turnover of between 25 million naira and zero. Okay, between 25 million naira and zero. So they will not be paying companies income tax, education tax, and then they will not be paying value-added tax, but they are not exempted from filing of returns. Okay, they are not exempted from filing of returns. So though as it is, they still file the audited accounts, even when the FIRS has it in the Finance Act that they may call for the returns. Okay, in such a manner as may be prescribed by them. Okay, so that's that. So that's that for. Sorry. Okay, so let's move. So that's all. So as I said, that we are waiting for the FIRS to come up with such a format, and if they eventually come up with this format, it implies that the cost of engaging the services of an auditor has been eliminated for small companies. Okay, has been eliminated for small companies. You understand? Okay, so the subsection 7 of section 55, okay, has amended through the Finance Act. Okay, gives the FIRS power. Okay, it empowers them to specify, okay, to issue a notice specifying the forms of accounts to be included in the tax returns of small companies, though they are yet to do that. So let's move. Don't let us waste much time on that. So now let's look at the filing and payments due date. Filing and payments due date. Every company shall file with the board its audited accounts and returns. In the case of a company that has been in business, that is a subsisting business, for more than 18 months, not more than 6 months after the close of the company's accounting year. And in the case of a newly incorporated company, within 18 months from the date of its incorporation, or not later than 6 months after the end of its first accounting period, as defined in section 29 subsection 3 of STATUTE, whichever is earlier. I've just mentioned it that the Finance Act of 2019 has abolished the gapping and overlapping we used to have in our basis period. So henceforth, companies will no longer be required to prepare their accounts. That is, a startup company or a company that has just commenced will no longer be required to prepare their returns in line with the old commencement rule. Okay, so now the Finance Act states that the first year of assessment will be from the date of commencement up to the first accounting year end of the company, and the second year will be from the first day after the first accounting year end up to the next accounting end, and then for the third year it shall be on preceding year basis. Okay, so meaning that it will be from the first day after the last accounting date to the next accounting date, so and so on and so on until the company ceases operation. So the penalty for late filing of returns, penalty for late filing of returns, penalty for late filing of returns is A, for the first month in which the failure occurs, we have 25,000 naira, and then for each subsequent month, we have 5,000 naira. Okay, so yes, the provisional tax becomes payable with attendant interest and penalty. That is, this penalty, okay, becomes payable with, so we say plus interest and penalty, but in practice they don't usually add interest and penalty to interest and oh, I'm sorry, you see, the Finance Act has abolished the provisional tax. Okay, there is nothing like provisional tax any longer. Okay, so what we have now is just for failure to file returns, 25,000 and 5,000. So the 25,000 provisional tax is no longer required. So let's move to tax clearance. Then we look at decided case to wrap up the class. I don't want to assume you all know what tax planner certificate is. You see, a tax planner certificate, otherwise known as TCC, refers to a one-page document issued by the tax authority to a taxpayer. Tax clearance certificate refers to a one-page document issued by the tax authority to a taxpayer on request, stating that the company or the individual stated thereon has paid all taxes assessed up to a particular period, indicated on it, or that they are not liable to tax. Okay, so application for tax clearance certificate is now done online with the FIRS. Now, what are the contents of a tax clearance certificate? Contents of a tax clearance certificate. Okay, so a tax clearance certificate shall disclose in respect of the last 3 years of assessment: 1. The total profit or chargeable income. 2. It shall disclose the tax payable. 3. It shall disclose the tax paid, and then the tax outstanding, or alternatively a statement to the effect that no tax is due. Now, let's check on the conditions to be fulfilled before the issuance of the tax clearance certificate (TCC). 1. The taxpayer must file his tax returns. The taxpayer must file his tax returns up to date. 2. The taxpayer must apply for the tax clearance certificate. 3. All taxes assessed on the taxpayer must be paid, including income tax, education tax, capital gains tax, IT tax where applicable, among others. So in the last 3 years, and then also there should be evidence of payment of value added tax in the last 3 years, and then evidence of remittances or payments of withholding tax up to date. So whenever the board is satisfied, that is, the FIRS is satisfied that tax assets on profits or income of the company has been fully paid, or that tax is due on such profits or income, it shall issue a tax clearance certificate to the person within 2 weeks of the demand for such certificate by that person, or if not, give reasons for the denial. Any ministry, department, or agency of government, or any commercial bank, either whom any person has any dealing with respect to any of the transactions mentioned in subsection 4 of Citn, in subsection 4 of Citn, okay, 2004 as amended, shall demand from such person a tax clearance certificate of 3 years immediately preceding the current year of assessment. Okay, now what are the use of tax clearance certificate? Use of tax clearance certificate. Use of tax clearance certificate. Sorry. Use of tax clearance certificate conditions. Use of tax clearance certificate. So the following are the uses of tax clearance certificates as listed below. We have for registration, so for an individual, for registration of motor vehicle, okay, and for companies too, for registration of motor vehicle, approval of building plans, okay, application for government loan for industry, government loan for industry or business, government loan for industry or business. We have application for firearms license, trade license, export license, export and import license. Okay, application for plot of land, application for buying agent license, gaming license, pools license, application for registration, application for registration as a contractor, application for registration as a contractor, application for distribution, stamping of guarantors form for Nigerian passport, application for allocation of market stores, application for registration of a limited liability company or a business names, among others. So an applicant for exchange control permission to remit funds to a non-resident recipient in respect of income accruing from rents, dividend, interest, royalty fees, or any other similar income shall be required to produce a tax plan certificate to the effect that tax has been paid on funds in respect of which the application is sought, or that no tax is payable, whichever is the case. Okay. So where a person who has deducted any tax under any provisions of this act fails to pay the tax so deducted to the appropriate tax authority, no tax clearance certificate may be issued to that person, even if he has fully discharged his own tax liability under this act. So if a taxpayer has deducted withholding tax at source on payments made to vendors or suppliers, contractors, but failed to remit these taxes to the FRS, so such application, the application of tax clearance certificate for such a person will be denied, even though he has fully satisfied his own tax liability. Okay, so where a person is able to produce evidence that he has suffered tax by deductions at source and that the assessment year to which the tax relates falls within the period covered by the tax clearance certificate, such a person may not be denied a tax clearance certificate provided that any balance of tax after credit has been given for the tax so deducted has been fully paid. Okay, so now let's look at a decided case, and that probably will be from the conclusions from conclusions reached from the warm spring, and then ORS versus FIRS on issuance of tax clearance certificates. Okay, so the details of the case is that Warm Spring Water Nigeria Limited, Ashmina Limited, 7-Up Bottling Company PLC, Votic Nigeria Limited, Nigerian German Chemical PLC, Adama Beverages Limited, Nigerian Bottling Company Limited, Rigolis Waters Nigeria Limited versus Federal Inland Revenue Service, Federal High Court, Lagos Judicial Division, suit number FHC, Lagos. The judgment given on 11th of May 2015. Okay, so in this landmark case, Honorable Justice I.N. Buba, as it then was, ruled in favor of the plaintiffs and granted all the relief sought in the following manner: that water, whether in bottle or packaging material, is a basic food item and therefore exempt from VAT; that the FIRS 2007 VAT exemption circular number 2007-02 of 30th November 2007 is not a clarificatory circular, but rather a purported amendment to the list of VAT exempt items in paragraph 2 of part 1 of the first schedule to the VAT Act. That the issuance of the circular contravenes the VAT Act and exceeds the powers of the FRS to make regulations under the Act. That neither the FRS nor its chairman is legally empowered to make an order to either amend, vary, or modify the list of exempt items, and even if they are empowered, they have failed to comply with mandatory steps provided in the VAT Act for such amendments to be effective. That to the extent that the 2007 VAT Exemption Circular 2007-02 of 30th November 2007 purports to amend the list of exempt items in the VAT Act, it is null and void and should be set aside and ignored as a pointless and ineffective attempt to amend primary tax legislation by an executive circular. The granting of an order of perpetual injunction restraining FRS, its agents, officials, and or privies, from withholding and or suspending the issuance of tax client certificate to the plaintiffs on the ground of failure to pay VAT on bottled water, as contained in Relief H, has further reinforced the consensus opinion that the VAT position of the taxpayer should not impair its ability to process tax client certificates. So tax client certificate application is a provision within the Companies Income Tax Act and not the Value-Added Tax Act of 2007. So non-compliance with value-added tax and withholding tax should not preclude a taxpayer from processing and obtaining its tax client certificate as appropriate. So it is instructive to know that Value-Added Tax Act of 1993 as amended to date has different provisions for different offences and penalties, and these are captured in sections 25 to section 37. Section 25 to 37, and do not include withholding tax clearance certificate of a company when there is a VAT dispute or outstanding reconciliation. Are we together? So thank you guys for coming to class today. Thank you once again for being quiet throughout the class. Thank you for your attention. Do have a wonderful diet ahead of you. Goodbye.